Today's market call is presented by CME Group, where risk meets opportunity, and FactSet, financial data and analytics powered by tomorrow. October 17th, 1 p.m. Eastern Time. Guy Adami, Dan, Nathan, market call. Let's get right to the rundown, Dan. Get right into it because Nvidia is absolutely fascinating today. Cascaded lower, has bounced, still down on the day. We're looking at a Nasdaq trade ahead of earnings, and of course, yields continue to move higher despite all the geopolitical stuff where you would thought you'd see a flight to quality, meaning yields go down. That's not happening. How are you?
I'm doing okay. You are powered by today, Guy Adami. And you and I, before we just went on here, you were saying this market makes absolutely no sense. This morning, you know what? You had that headline about, okay, this had kind of been little trial balloons floated here. You know, Nvidia, you know, these advanced graphics chips, they're being banned for sale to China. We know that there had been lots of workarounds, lots of sales in the gray markets, a lot of double, tripling ordering by a whole host of folks there. They were finding their way to China. There was also some tweaks to those chips, right? That kind of fell within, I guess you would call it, I don't know, semantics or whatever, Guy, right? Like a little, you know, they were getting sold into there. So the Biden administration, they tightened it up a little bit here. The headline comes out. Stock opened down 5%. And you and I were talking this morning on the phone, and it dropped like $10 like that, another 2%, like in a straight line. I was kind of, look at that beautiful little FactSet chart there. What did that look like, Guy, up there? A little bit.
Well, it looks like a lot of things, but I'll keep it clean and say that looks like a bit of a head and shoulders formation. And a lot of people are pointing that out today. I've read some emails indicating exactly that.
Yeah, well, our main man, Doug Cass over there at Seabreeze, who also writes for Real Money, had a great note out yesterday preemptively on some of these issues with Nvidia being a canary in the coal mine. We are in that sort of camp in a way. And, you know, when it's going to take, and these guys will report off cycle, Guy. So not until November, once we've seen all the reports from the OEMs and the semi guys and all the cloud players and everything like that, then we're going to get Nvidia's earnings and guidance. And I suspect that, again, we're seeing a sequential deceleration in the growth that we've seen year over year. They've still been eye-popping. And maybe, just maybe, a lot of folks kind of believe that it's growing into a valuation if you believe the 2024 estimates and the like here. But again, that technical pattern, you know, with $1 trillion plus market cap. And so if you're seeing that sort of deceleration at some point, Guy, I mean, the chickens have to come home to roost. You and I both think that there's probably a retest of that 200-day. If we do break that support, that neckline maybe fills in that gap for May.
That's exactly right. And I don't know if Stephen or Jacob can pull up a longer-term chart and take us back to November of 2021 or even a little earlier than that. But if you recall, I think at the time, the stock was making an all-time high around 330 or so. And I don't know if we can highlight that, but you can basically, your eye can go there and see. So there are a lot of points here to take a look at. That gap in the chart sticks out like a sore thumb, and I think it's just sort of longing to be filled. And there are a couple areas along the way, and people say, out of your mind, it's never going to happen. Well, it's happened before. We've seen moves of this magnitude to the downside before in this stock, and who's to say it can't happen again? And when you see a day like today, where at one point, as you said, Dan, it was probably down $28 or so, maybe even more than that, maybe over $30. You can see how quickly things can go pear-shaped. Obviously, it recovered. We'll see how it closes today. But to your earlier point about the broader market, it made sense to me this morning that the market was getting throttled. I'm choosing that word. Yields were higher. We'll talk about that. But it's come roaring back, which, again, it's somewhat counterintuitive to what I thought would happen today, given everything that we just, at least those two things that we talked about.
Well, most importantly, the yields. I mean, like,
well, that's it. That's my point.
Just before we leave Nvidia here, let's pull up the day chart, because this is pretty astounding when you think of like just the intraday volatility for a stock that gapped down 5%. This is one of the largest stocks in the entire stock market. If you just look at that sort of intraday, maybe they can do a 2 or 3 day here to just show kind of where it was. Look at that. So to have that sort of gap and then go in and attempt to fill in that gap. And so let's see where this stock closes, which brings us to the SMH, Guy, the ETF that tracks the semiconductor index. And again, you know, our good friend Tim Seymour on CNBC's Fast Money has been highlighting the relative new highs that we've seen in the semis of late. If you just look at the SMH, though, that's relative to the S&P 500. listen, this thing is banging around. It really hasn't made a new high. Well, it's made a couple of attempts, and it's made a series of lower highs. It really feels to me like it wants to kind of test that support and that 200-day moving average. You just see the 200-day is much closer, there to the SMH than it is to the Nvidia. But a lot of that has to do with the other large component, Taiwan Semiconductor, which was at one point in the last few weeks down more than 20% from its 52-week highs.
Again, I'll ask Jacob or Steven to go longer term, and you will see, if you can go back again to the
5 years,
similar
yeah.
time, you'll see a pretty classic double top formation in the SMH as well. And that's something that we've pointed out a number of times. And that doesn't get any clearer than that, Dan, in terms of, levels and where we stop. Now, people will say, listen, technology, semi-specifically, it's a new oil, and you can't run too far from these. And I get it. I'm also going to tell you this: as we get into the fall, as we get into the winter and early next year, and you've brought this up, so I'm not breaking any new news. I think you're really going to start to hear about the double and triple ordering that went on out of necessity, maybe, but it doesn't really matter the reasons why. I think that's going to have, as Dennis Gartman would say, a deleterious impact on these names, and then subsequently the broader market as well.
Yeah, this chart is also interesting because we brought it up on the fly. I mean, you could draw, an uptrend from the lows last year, and you see that we're contending with that. You could draw that a horizontal line from the prior highs a year, in 2021, and you see, a pattern that is either a flag that's looking ready to explode, or it's going to be testing, the lower ends of that kind of uptrend channel. And if you want to throw a 200 in there, we know it's below. And so, you get it. I mean, like, listen, we're getting very close to a kind of make or break sort of situation, I think, for the year, for the market, that is, Guy. I mean, like, just seasonally, and this is another one. I'll give Tim another shout out. I mean, he's been saying it on the desk on Fast Money for the last few days. And, what I wasn't paying attention to, Guy, is the closer we get to November, and you and I know this, is the least likelihood that things fall apart. The lack of visibility maybe that corporates have now with what's going on geopolitically, maybe that's something that maybe causes, some consumer, we're going to talk about the consumer in a little bit, some consumer, pullback or something like that. And I just don't know, but
no, but I'll push back a little and say, and you're speaking to a certain extent, seasonality. And as we get again through November, things get quiet, holiday, all that stuff. I totally get it. Of course, there's so many things that have happened over the last year, but then specifically over the last few weeks, you're coming up to, the middle of November. I think it's the 16th. Don't at me if I'm wrong, but this debt ceiling is going to come up again. I don't know. I didn't see it. I don't know if this vote for the speaker went through. So you're still talking about a lot of things out there, sort of nebulous at best. And the market historically doesn't particularly like that. So we'll see how it shakes out. But the yield move, to me, again, we've been harping on this. One would have thought, given what's transpired over the last couple of weeks, you would have seen yields move down dramatically. And for a day and a half, 2 days, you did. I mean, I think we got down to about 4.55 or so in the 10-year-ish. Yep. And now here we are right back above, 480. So yields want to go higher here. I think I know what it means for equities. Right now, though, it's not really playing out that way, Dan.
Well, all right. So let's think about this for a second. So I'm looking at the 2-year, Guy. It's at 5.21. Okay. So if the 2-year is closely tied to what essentially Fed funds, right? We know that there's a Nov 1 meeting, right? And that's the second to last meeting that we're going to get this year. And is it because of, I guess, all the dovish talk that we heard after the terrorist attack in Israel? Is that the reason why we have the CME Fed funds tracker, pricing in less than a 10% chance of a 25 basis point hike? Maybe that's it. But again, we talked about some of these inflationary readings that we've been seeing, CPI, PPI, the jobs report from September a week and a half ago. It just seems like, the Fed, your point has always been careful what you wish for a bit. It seems like that maybe some of that data is out of their control. And if they were to let too much of a pause or too much kind of dovish talk work its way in, then maybe you do start to see inflation actually pick up from here. I mean, I know it's picking up year over year, and we know that some of those readings, on a sequential basis have come down pretty substantially, but now they seem to be picking up a little bit.
Prices are going higher still. They're just going higher at a slower rate. And I'm not trying to be wonky here. I'm not trying to be glib, but that's effectively what we're seeing. So don't confuse, and I'm not suggesting you are, but the lower readings with
Yeah.
inflation is cascading lower. Prices are still going higher. And when you sort of do that on a cumulative basis, people are hurting out there. And again, at a certain point, it's going to make its way into the equity market. By the way, you've seen it already in a lot of these consumer brands. I mean, we've talked about General Mills, Kellogg's, all these names that have just been getting throttled. And I think part of the reason, I mean, we can talk about this sort of the ancillary second derivative, third derivative reasons, but the first derivative is they can no longer pass on their cost to their customer, and margins are starting to contract. And that is problematic in that vertical, but I think subsequently it's going to be problematic across a swath of verticals.
Yeah, let's pull up the XLP, the ETF that tracks consumer staples. And this is one that, was trading $78 at the start of May, or almost $78, and traded, 68 on a couple of occasions over the last week and a half or so. You see that sort of consolidation. You see the widening of those volatility bands. I think Pepsi is a large component. Pepsi reported about a week ago or so, and the stock had a little bit of a bounce, and then it came back in.
Yeah.
It was all over the place for a few days. It looks like this thing is trying to find a little bit of a bottom, but you can see the levels here. I mean, that 66 to the downside, guy, you don't want to be breaking that anytime soon, because if you do, I think that what's going to be clearly embedded in that is like, okay, rates for longer. I get it. These were staples, and these were, high dividend paying things. And with yields, they're less attractive. And if pricing power is waning and all that sort of stuff, I get it. Okay. The flip side of this is that if the damage was done, you know what I'm saying? We took many turns from a valuation perspective off of many of these large names. You know what I mean? Like, so this is a battleground that I think is worth paying attention to. Does that make sense?
Of course it does. And again, we're getting a little granular here, but pull up a Pepsi chart and go back to 2021 if you guys can. And I want to sort of show you something, and this is very Carter Braxton Worth, but since early 2021, when this stock was probably trading about $129 or so, you made a series of higher lows and higher highs. That stopped in May of this year, when I think we made an all-time high of about 196 and change. Since then, you're basically starting to have a series of lower highs and lower lows. The level we're trading at, this 160 level, is absolutely sort of a line in the sand. And you go back and look at these lows that we bounced off of. So you can see it there as clear as day. And again, you're saying, guys, it's just Pepsi. It's not a big deal. I understand. It's not a big deal, right? In the scheme of things, but this is a $220 billion company that hasn't been trading particularly well now for the better part of this year. And it's not just that. And the story they're telling, I think, or the story they told is, hey, inflation is great for us because we're just going to pass it on. Our margin's going to improve. And that was the story basically from 2021 into earlier this year. That has now flipped. And when that flips, as you know, you can't just turn that right back on in terms of getting those margins back.
Yeah, no doubt. So like let's like on the back of the yield thing. So late 2021, when the Fed said they're going to battle inflation by raising interest rates, the hardest hit things were unprofitable tech, speculative crap like SPACs, crypto, all that sort of stuff started getting hit. And then we saw many tech stocks, but with high valuations, very profitable companies, they started to correct in Q4 of 2021. But the major indices continue to make new highs, right? The Nasdaq did top out, I think, in early December of 2021. But it was the S&P that didn't really top out until the first week of 2022. Why am I bringing this up? Okay, well, you and I have mentioned this on many occasions. I think there's a lot of similarities right now in the market in Q4 of 2023 to what we saw in 2021. And I know a lot of people are saying, well, listen, what's different now is that Fed funds was below what? 50 basis points back then, and now it's 5.5 percent or something like that. So we're closer, much closer to the end of these hikes. Now you talk about these long and variable lags, and a lot of folks in the Fed like to speak in that sort of language. I'm not saying that you like to speak like the Fed people, but what you and I have tried to talk about how for whatever reason the economy seems to be hanging in there despite the pace of interest rates, despite inflationary readings. My view, Guy, is that what? If it weren't for these, top 10 stocks in the Nasdaq, right? Like a lot of the devastation we're seeing under the hood and a whole host of different parts of the market. It could be banks, it could be retail, it could be staples. It was energy for a bit. It came back a little bit. It was utilities. It was industrial. I mean, the list goes on and on and on, right? So when I think about tech, let's go back to that Nvidia chart. Okay, so that's up 200+% on the year, right? It's got over $1 trillion market cap. We knew that did a lot of the heavy sort of lifting. If I look at Apple, okay, Apple, we just saw some data about China and iPhone sales there. Not particularly great. I would say that their demand for their key product in a key region is kind of waning. Tesla, we're going to get their earnings this week. They're likely to put up something close to a 17% automotive gross margin, guy. Okay, down from 25% a year ago. So I have 3 companies where, the first one, Nvidia, maybe just maybe the fundamentals are great, but maybe the valuation's a bit out of whack for what you and I think could be coming. But Apple's not getting better. Tesla's not getting better. Amazon AWS growth was about as low as it's been in 10 plus years, and it got bailed out because of retail. Okay. Google is still in the sights of OpenAI and Microsoft and that sort of thing. So the jury's still out on there. I'm probably missing one of those other sort of 7. So so Facebook, let's just put it in its own little camp. They can do whatever it wants. Elon Musk has made Mark Zuckerberg like a saint, which is amazing if you think about it. Okay. So all I'm saying is this Magnificent 7 is not looking so magnificent to me anymore. And if there's any hiccups in the Nvidia, I think it's taken the whole market down.
I agree with the Nvidia portion of that. And I'm right. They all Facebook, Google, they all have their issues. And if you could pull that Tesla chart up real quick.
Yeah.
And I know Jacob and or Steven can do this, but you go back to early 2023. So that low that we made in, I guess, January. And there's a trend line. If you connect that low to sort of the May low, and then you could probably get even sort of the late August, September lows. That's your uptrend line. The downtrend line is from that high in July and those 3 points on the downside. So as they're drawing this, you can see exactly what I'm looking at. There's your uptrend line. Your downtrend line is from that high in July and then those 3 points. And here's your pennant formation. So you tell me, let the market be your guide. And that's just, we didn't rehearse this, but you do this long enough, you start to see things. But there's your pennant. And that pennant is happening into earnings this week. I don't know what's going to happen. I mean, I sort of think I know what's going to happen. But my point is, something pretty major is going to happen with this formation. We get in tighter and tighter ranges into this pennant, earnings release, something's got to give. That's how I look at Tesla here. And I think, there are a lot of charts that probably look similar, Dan.
Well, I'll just say one thing. Okay. And I think the number was 11%. Auto sales for Tesla in China in September were down 11%. Okay. And then we saw, I think year over year, Apple sales of iPhones from 2022 from their 14 device. I think there was some reports that they were down mid, single digits or something like that year over year. We've talked about this. Apple and Tesla will be the 2 last battles fought with China. Why? Because they employ a lot of people making lots of, of their devices or cars, whatever the hell you want to call them over there. And those 2 CEOs have actually made it their purpose to cozy up with one of the most totalitarian regimes on the planet. I mean, that's just a fact. Okay. I still have an Apple iPhone. I have lots of Apple products. Okay. So I'm not speaking with my wallet. You can call me a hypocrite or this and that, whatever. I certainly don't have a Tesla, never will. But those 2 companies, man, they have a China problem. There's no doubt about it, because if this is about nationalism, which it really well could be, Guy, you talked about, I think a few weeks ago, you were saying the shadow banning, of Apple devices by government, agencies in China, that has the potential to work through in other ways throughout.
100%.
Yeah.
So I think real quick, I don't know if maybe I misread, but I think Tim Cook might be out there now.
He is.
Which is really remarkable if you think about it. And it speaks, and again, maybe it was a planned trip for the last 3 years. I have no idea. But for me, the outside looking in, it sort of reeks of a bit of desperation and be like, come on, Apple's not, well, there's stuff going on without question. And China could absolutely, listen, whatever it reeks of, I mean, if China really wants to wreak havoc on the markets here, the first pillar to fall is going to be Apple. So they pull that peg out, and then the cascade effect happens. And quite frankly, if I were in charge over there, that's exactly what I would do. You always have to put yourself in the seat of your adversary and say, what would you do if you were in his or her seat? And that's exactly what I would do.
Look at you, little Machiavelli sort of stuff
Well,
there.
no, but I mean, it makes sense though if you think
Yeah,
about it. You have to
totally.
try to think how your adversary is going to think.
No doubt. I mean, listen, the other point about Apple is that like the further they move to kind of, reshore manufacturing and the like, I mean, President Xi looks at this company and probably says, listen, we have Xiaomi, we have Huawei,
We don't need you.
we have all these other things and we give you access to our emerging, middle class of consumers, that sort of thing. So, you brilliantly dictated that Tesla pennant formation. Let's pull up the Nas futures here because this is where we're going with all this. Okay. And so we know we're going to get Netflix tomorrow. We're going to have Carter Braxton Worth on the market call. We're going to be charting Netflix and some other tech charts here. But let's look at the Nasdaq futures here, and you see that series of lower highs, guy. You can just draw that line pretty easily. You see that uptrend there. So the tension is building here. You see that 200-day moving average is down there below 14,000. I think it's like 13,900 or so.
Right.
So listen, I've taken a couple cracks in the options market, guy, in the QQQ on the downside here. I've tried to roll that view out a little bit. I want to take a look at the futures now, and I'll tell you why. I want to use some stops here, and I want to use some sort of intelligent stops and taking a crack at this one more time here that maybe, just maybe, we get a move back towards, and you kind of detailed this really well yesterday. We're going to take a look, or last week, excuse me, on Tuesday in your futures trade, looking at yields, okay? I want to do the same thing. I want to see how this thing acts as it gets closer towards that downtrend that we just showed you. But if I was putting this trade on right now in the NASDAQ 100 futures here, I'm looking, okay, to sell this here at about 15,280. I want to stop it at the high from October 12th, okay? That's 15,480. So that's about 200 points. And if you're looking at the minis, you guys can do the math on there. And you listen, you guys should go to the CME website. They have lots of calculators. They have lots of ways to kind of, detail how much capital is at risk and what the leverage is and the like here. So that is my stop to the upside here, because I feel like if it gets through that high, guy, if it gets through that downtrend, then it's off to the races here. But what I want to do is kind of attempt to make a move that it's going to go back down towards that uptrend line that's been in place. And then ultimately, if it gets through there, then it makes a move back to its 200-day moving average. Now, we would need a whole host of things to happen, but we'll talk about that. So my initial target would be 14,580, selling them at 15,280, and I'm stopping it at 15,480. What do you think of my levels? And maybe they could throw up the other chart here, because that could kind of be illustrative of what I'm kind of trying to work.
Well, I mean, so put that one back real quick, the prior one, because you're looking like a 3-to-1-ish risk reward, I guess, sort of back of the envelope, maybe a little bit better than 3-to-1, which is about where you want to be. The stop level is correct. It might seem tight, but it's the right level. The take profit level, I mean, that's the first leg lower up against that support. And theoretically, you can take off a portion of your position and then let the rest ride. Or if you really want to be aggressive and it starts to cascade in a meaningful way, you can add to a short position and then obviously lower your stop significantly. We talk about trailing stops all the time. So I think in terms of the stop level, which is the first thing I look at, I think it's the correct level. And then the second thing I look at typically is, okay, what are you risking and what is your potential reward? So typically, I don't think you want to do anything worse than 2-to-1 in your favor. If it's 1-to-1, you're just flipping coins. 2-to-1 is sort of the minimum, but 3.5-to-1 makes a lot of sense.
Yeah, and if you're the sort of trader who likes to kind of get in there and take much smaller losses and kind of get the vibe for what's going on, I mean, like, this stuff doesn't happen only in a vacuum. So like just if you're looking at how the markets transpired today, if you had rushed out when on the opening and as the like the Nasdaq was just red, it was a sea of red, and you thought that this Tesla or excuse me, this Nvidia story was really going to take the whole market lower, right? And you shorted that thing, and you're like, you had to stop up there at the October 12th high. I mean, that's a long ways to go, and that's a long ways to be wrong too. So some of you, and I know, like, I like to trade this way. Sometimes they take a little short chops at things and see how things are acting, and take a breath every once in a while if it feels wrong. All right, let's look back last week. You were trading yields, and again, you thought they'd go higher. It was a really nice call. Let's first kind of walk through some of the stuff, because I think there's a couple things going on here, Guy, before we get to your trade from last week. Like, in the Journal today, there's 2 headlines. Maybe these guys could throw this up, but I thought this was really interesting. It's getting too expensive to have fun. Okay. They're talking about how live events and experiences have just gone, parabolic in their pricing in the last year or so, and they gave lots of different examples from NFL football games to Taylor Swift concerts. The list goes on and on. And then the other side of this, and we've seen some retail data, is that the American consumer keeps splurging. So we have credit card debt at crazy highs. We have that at levels of interest rate levels that we haven't seen in a very long time, right? But we also have a U.S. consumer that just continues to spend, and so there seems to be a lot of cross currents here, which is one of the main reasons, I guess, why we're still having this inflation debate.
Consumer, again, for new members, I've said many times that never underestimate the United States consumers want to spend. They will spend just about under any circumstances we can come up with, unless something scares them. And what typically scares them, Dan, in my opinion only, is a move in the market. Again, not to suggest that everybody owns stocks. We know that's not the case. But people sort of look at the stock market as a gauge of how things are going. And when the stock market's doing well, up every day, everybody seems to think, well, if the stock market's doing well, it must mean the economy's doing well. If the economy's doing well, why shouldn't I spend? I see what my neighbor's doing. I know what he or she makes. I'm commensurate with that. People get scared when, again, the evening news leads with U.S. equity market down 1.5%, 2%. You see that over the course of a couple of days. Then all of a sudden, everybody sort of looks up. It's like that scene in Jaws. Barracuda's not a big deal, but you yell shark, and everybody freaks out. And that's the same thing with the stock market. So I get all these headlines. They all make sense. But if we were to have a move lower in the stock market in a meaningful way, and we've seen this before, consumer spending in this country will stop on an absolute dime.
Yeah. Well, our good friend Peter Bookvar, Bleakley Advisors, he writes the book report every morning. It's one of our first reads, but he had a great comment here on this morning. He was talking about how he's heard from many retailers, and Peter, he literally reads many transcripts, earnings transcripts, and listens to dozens and dozens of calls. But he said that retailers the last few months have been saying how they've seen the consumer prioritizing its spend. The consumer is not spending as much on goods like furniture, building materials, electronics, clothing, and sporting goods, especially at a time where we've seen housing, just go through the roof. And then we've seen gas prices and some food prices kind of reaccelerate. So I think that's kind of interesting. But again, let's pull up the 10-year U.S. Yield here. Last week, you thought rates were going higher for all of these sorts of reasons here. And, when you look at the 10-year, look at that thing. I mean, it's about to make new highs. I thought we'd see a retest guy of that breakout level from a few weeks ago. You think they keep marching higher. I wonder, though, when we have that 10-year, if it gets to 5% or above that, is that going to be like the thing that maybe wakes up the equity markets? Because on a day where 10-year yields are up 12 bips and trading at a new cycle high here, the fact that the stock market is kind of holding in here, and basically the S&P is up 15 basis points and the Nasdaq's down 15 basis points, largely because of the Nvidia, it doesn't make a lot of sense to me.
You look at the Nasdaq, I think, rallied from low to high about 180 points, which is remarkable. It really is remarkable. So does it make sense to me? No, because given where yields are, that move lower should have continued. All right, so be that as it may. Your question was, what level do rates start to sort of kick on everybody's radar screen and they matter? I
think you froze here.
Correction, that clearly wasn't the case. Maybe it is as simple as 5%. Maybe it's that whole round number thing, and people look up and, oh my God, 10-year yields are at 5%. I'll say this again. Given what's transpired geopolitically, if there ever to be a reason for yields to go lower, it would have been on the back of that. And you saw it for about a day and a half, 2 days, when we got down to about 4.5, 4.55, and we've snapped right back up. The bond market is telling you that the participants are demanding a higher yield to buy. It's as simple as that. And the incremental buyer, or the large buyers that have been around historically, the Bank of Japan, the Federal Reserve, some of these other players, they're not in the game right now. As a matter of fact, the Bank of Japan has their own problems. They're trying to defend their currency, and they're probably doing it by selling our treasury. So There's a lot of things to be concerned about, but it all manifests, it all takes place in the chart you're looking at right there.
Yeah, no doubt. All right. So last week on October 10th, you wanted to sell the 10-year futures. Okay. You sell the yields at 107.90. Your target was 106.10. Your stop to the upside was 108.45. So here we are. We have this thing, Guy, going in your direction here. Where do you want to move that stop to now?
Yeah, well, look, you move the original stop loss was like 108.5 ish. So obviously we've moved dramatically lower. So you can do a couple things. I mean, you can move the stop down to your entry level and you're in the trade for free. In other words, if you get stopped out, no harm, no foul, you put it on at the same level you took it off. I mean, that's one way to look at it. You obviously can move the stop lower than that and basically guarantee yourself some sort of profit on this trade. That makes sense as well. I mean, in my eye, I would put it somewhere around 107.5. So you sort of get the best of both worlds. Worst case, you make a little bit, but you're still sort of in the game. So let's just call it 107.5 ish or so on now it's on the upside. Number one, in terms of take profits, I think I said 106.10 ish. I think we got pretty close. I still think we're going to see that level. And maybe you take off again, a quarter, third, half of your position. And if we're to get down, then maybe you drop the stop from 107.5, maybe down to 107. So this is a living, breathing thing. And when you're trading futures, that's exactly how you have to look at it, Dan.
Yeah, no doubt. Nice trade by you, and I like the way that you're managing this trade. Before we get out of here, we definitely want to get a couple of earnings, but I wanted to hit two other things in the CME futures world. I want to look at copper for a second here. It was interesting, and it caught my eye, Guy, because Freeport-McMoRan was initiated today at JP Morgan with a neutral rating, $42 price target. Stock's trading around 37.5. Stock's really in sort
nowhere.
Of yeah, it's kind of nowhere. But let's look at the copper for a second here, because this one is kind of interesting, not trading particularly well. And give us your 2 cents on why copper is one of those things that a lot of folks, as they're trying to gauge the sentiment of the markets and how's perceiving the economy, why copper is important.
The old timers will say that copper is the most economically sensitive commodity out there. And I understand that crude oil is a commodity, but people that do this for a living say, crude is one thing. Copper, though, really tells the tale of the economy in the aggregate. So to the extent that they call it Dr. Copper, back in the day. And when it doesn't trade particularly well, effectively what it's telling you is the economies globally are starting to ratchet down. You can't pinpoint one economy necessarily, but this is a global commodity. And when it starts moving, again, upper left, lower right, it's telling a story. And this chart speaks to effectively the weakness we've seen this entire year with a couple ticks to the upside. I mean, each one of those ticks to the upside, you probably can explain in some sort of event. But in the aggregate, this has been going lower, and it makes sense because, quite frankly, that's the same trajectory as global economies.
Yeah, the one thing I'd say is, like, look at that June low that it's contending with. We could have drawn a little bit of a support line there going back 1 year. It seems to be testing it. And then if we just want to back this thing out, we have a 5-year chart. Guy, look at this thing. I mean, that uptrend that's been in place from, the kind of early 2020 COVID low is being breached, right? And if you see that kind of well-defined, and we kind of highlighted that through that trend channel over the last kind of year or so, I mean, it's breaking down. So again, we're not trying to place too much emphasis on this sort of thing. Use the kind of term old timers, that sort of thing. Maybe it's a little outdated, but technically copper does not look good. And it caught our radar because we saw initiation.
No, but and listen, I know we got to get out of here. I think you're right to bring it up. Now, if what I just said is true, if copper again is as economically sensitive as I say it is, then yields should be going down, not up, right? Because yields theoretically going higher are a gauge of economic strength, not weakness. So if I just told you that economic weakness is out there, there are another reason that yields are going higher. And yields are going higher in the face of what we just talked about, which I think is somewhat concerning.
Yeah. All right. And then let's look at your gold here, because this is at a level, Guy. This is at its 200-day moving average. It's also at that downtrend that's been in place from, the last time it was above 2000. That was kind of May, April-ish time frame. This is like a moment of truth. Would you say, would you agree with that?
100%. This downtrend's in place. If we were to go longer term, if Jacob can pull up a chart and you can go back to, I think, a few Augusts ago when we traded up and failed, and then this recent high we saw in the spring we failed at. I mean, the tops are outlined there for you. So I do agree with you. This downtrend is pretty critical. It happens to coincide with the moving average as well. I think everybody here knows what I think. I think we're going meaningfully higher. And I think what's going to wind up happening, thank you, Jacob, is when we get through those highs, and you can see all three of them, that's when the systems are going to kick in. That's when the institutions and the hedge funds and this larger pools of money are all going to try to flood their way into the gold market because that's what their systems tell them to do. And the reality of the situation is the gold market cannot take the amount of dollars I think are going to try to make their way in. So I think the fun is just starting. Other people say you're out of your mind, you have tinfoil on your head, and I still don't really understand what that means.
You do not. All right. Last thing, Bank of America. We've been talking about it a lot over the last few weeks, the underperformance relative to many of the other money center banks and basically some of the issues that they might have in their kind of held to maturity, mark to market, treasury portfolios here. This is interesting, Guy. Okay. So, this thing fell off the bottom right of this chart a couple weeks ago. We thought at the time, not a great press on the short side. Sentiment was really bad. Technically, if you just look at this thing, the results, weren't as bad as expected. And in some places they were probably okay here. 28, kind of a big level. If you look at how the stock acted in many of the banks out of Q2 earnings, they did have a nice run. They broke out of these consolidations that, they were really banging along those kind of regional banking crisis lows from March and April. And they had a big run, got to some levels, and then they broke down and broke down in a meaningful way. Let's look at the 5-year Bank of America for a second here too, Guy, because it goes all the way back. If you look at where the stock just found a little bit of support, that's the November 2020 gap that happened with the vaccines, the election and the like here, kind of at a level.
The unrealized losses on their balance sheets with yields continuing to go higher are only going to continue to grow. Now, people will say they're unrealized losses. They're going to let this roll off. Okay, that's fine. You want to play that game? They're going to hold it to maturity. HTM, hold to maturity. That's fine. But then think about this. There's an opportunity cost associated with that. They've put on their position. Their position sucks, and it sucks more each day with rates going higher. So those, in my opinion, those unrealized losses will continue to grow. Again, people will say it doesn't matter because they won't hold them. Fair enough. Flip side of that coin is that's the opportunity cost that they're not going to be able to get back. So it makes sense that this stock sucks. Yes, you got to bounce today, whatever. It's not all that impressive to me. And I think we still go lower in Bank of America.
All right, last thing. So our friends over at CME Group, it starts on Friday. This is something that you, Danny, Moses, and myself are going to be participating in. Look at this, the Epic Equity Futures Trading Challenge. This is going to be fun. We did it with the bond futures. We did not, none of us did particularly well. We're going to do a lot better in this one. So we're going to be there. We want all of our loyal viewers of the market call to get in there and trade the heck out of the equity futures. And this is all paper trading, people, and it gives you access to all the tools on the CME on their website. And it's really meant to be an educational sort of experience, but encouraging our fine viewers and listeners to go up and sign up. We're going to do a giveaway. Last time, and many of you participated in our giveaway for the risk reversal market call water bottles. This time we're going to do a hat. I don't know if this is the final hat, Guy. I think there's a mock-up of a hat that we're going to send out, but go sign up for this challenge. Screenshot your sign up. Send it to contact@riskreversal.com. You know who to bug. That would be Amanda.
Blow up Amanda's inbox.
Blow it up. Send her a screenshot, and then we will be sending you a risk reversal market call hat. And we appreciate you guys participating. I think hundreds of our folks signed up last time. So get all up in there. They had thousands and thousands of people participating in that. And it was a lot of fun.
It's free education. It allows you to sort of test drive things without having to sort of put your own dollars at risk. And it gives you a real experience in how you trade futures and how you trade these different instruments. I think it's great. We're giving away hats because I think there are going to be a lot of carryover people and they don't want another water bottle. So you can get a water bottle and a hat for you folks who are going to do it instead of futures with bonds, do it in the equities. hopefully there's some new folks as well.
Yeah, and you guys can find the registration link. I think it's going to be in the show notes, and it's going to be in the YouTube, and it starts on October 22nd. That's when the challenge starts. So go in there, register, get yourself a hat. Wear it with pride. Guy, you don't wear too many hats, do you, on that fine head of hair of yours? No, you don't. And you definitely don't wear truckers. Guy he doesn't care what's on the hat. He just doesn't want it to be a trucker hat. That was the instructions that the team got.
Well, I don't even know what that means.
It's the mesh hat in the back. It's
I hate the mesh. Oh no, I don't understand that. I'm sort of old school.
Trucker hat.
Yeah, I don't buy the hats with the adjustable backs. I mean, I'm sure that's what these are.
What's
I'm sure
your hat?
they're lovely.
Like 8 3/4?
I think I'm 7 5/16 or 7 3/8. I'm not sure.
What would that be? 4-3-7-5? That'd be 4.
That was Jacob. We just got a glimpse of Jacob.
I don't even know what the heck's going on with that.
Listen, you got to know these things. 3 aces, 3 set. Yeah.
I nailed it. So back in the day, this is a little thing. So when I started the market, when you started, they were probably just trading in dollar.
No, listen, see this? This is how we used to figure things out.
I know, but when I started trading, in 1997, it was in I want to say quarters, ace and quarters, maybe, but yeah, ace and quarters. And then they went to they went to the teenies, they call them, right? 15, 16th, which would be 0.9375. Wouldn't that be correct? So we had to learn all that stuff on the 10, but then they just went to decimals, which was a lot better.
Well, maybe not. It really depends on what side of the business you're in. And that's another one of these. Be careful what you wish for. But that's for another day, Dan Nathan.
All right, bud. We covered a lot of ground here. Thanks, Guy.
I enjoyed it, folks. Thanks for spending your time with us. We'll be back tomorrow. I think the great Carter Braxton Worth of Worth Charting will be joining. So thanks, everyone. Sign up for the CME Challenge. Talk to you later.
See you.